Steve Kroll has been managing money for more than 40 years. Is currently a managing director of Monness Crespi Hardt Co, where he advises institutional investors. He joins us here on set. Also, of course, with us from the New York Auto Show, my co-anchor Matt Miller. So, Steve, do you still think we're going to get that full downgrade of AAA?
Absolutely. I think the market's starting to price it in. The numbers speak for themselves. Let's take the emotion out of it. And granted, we're all part of this great country, and it is the best country in the world. But the numbers don't lie. You're talking about a budget deficit this year of $1.6 trillion, a debt level of about $15 trillion. That's not counting the off-balance sheet financing. And if you add in the help with Fannie Mae and Freddie Mac, which are off-balance sheet numbers, and the Social Security and Medicaid, Medicare, it gets up to be almost $30 trillion. So that's not what I consider AAA credit. When we do the definition of AAA credit, it's above and beyond. It's great. This is not. Now, we may take steps, but we have not. If just to quickly digress, 2 weeks ago, they almost shut down the government over just $40 billion. That's 1 week's deficit.
That's politics.
But that's not progress.
Steve, let me ask you, Austan Goolsbee said that this was just a political move on S&P's part. I mean, he said that we should have confidence that there's consensus in Washington that they really will do something about this. You don't believe that?
Well, I hope so, and I think that they are now talking about it, which they haven't done in the last couple of months until recently. But I'd like to see real steps. I mean, when Obama came in, and part of it's his fault, part of it's the Republicans and the Democrats, it was a $10 trillion debt level. It's now $15 trillion. We're still going the wrong direction. And these plans to cut it in the next 12 years, well, that could be 2 presidents later. That doesn't work.
It's interesting because here we are Wednesday, and it feels like it never happened because the markets certainly seem to be shrugging off. I know they're focusing on earnings. We talked to a bunch of folks on Monday who did kind of shrug off that S&P move. Folks, listen up to this.
Is not a reassuring development, but I mean, I think it was sort of a grandstand play by S&P.
This is simply an opinion. It's one of 20 million opinions about the fiscal condition and political environment in the United States, and it's not based on any sort of research.
This alarmist attitude that S&P is taking is weird as to timing.
I mean, they bring up some good points. I mean, the timing was interesting. Was it just to nudge the guys in Washington to kind of move along here?
I'm sure part of that was the case. And I can't argue with the 3 speakers before. But we've had a QE1 and a QE2. The last time QE1 stopped, we had a correction in the market. Sid Williams, a strategist at our firm, said the market was down 13%. I talked to our head trader this morning. He says the market, even though we're having a big rally today, Peter Zecca indicated that the market's a little bit frothy. So we think, as we said on here, we think this year is going to be an okay year, but nothing great. We still have this big macro problem, which is rates will probably start to tick up. Inflation is still getting out of control. And I think the market's going to be okay, but nothing like a lot of people are saying.
Hey, Steve, we have you on because Wall Street listens to you. Hedge funds pay you for your advice. What are you telling them about what's going to actually happen in the market? You think there will be a downgrade, I think, by July, right? So how does that affect fixed income? How does that affect equities?
Well, we have disliked, and we've mentioned on the show a couple of times, treasuries. We still like common stocks, some common stocks, bonds, particularly corporates, okay. And munis, we've always long said the muni market is, people are overreacting on the downside. So we have a number of lists of equities that we like on a research basis. We've liked the energy stocks for a long time, the oil service stocks for a long time.
You sometimes
the
like
natural
some housing
gas
guys too.
Housing we think that's priced into the market. Housing is slowly picking up.
But the numbers still come out and they're still pretty ugly, Steve.
The stocks sometimes tell you a little bit more and quicker. We recommended Lennar back here at $10 a share. It's 19. Pulte Homes has moved up 30% in the last couple of weeks. The housing is starting to get better. It's not optimistic yet, but it's getting better. And then all the energy stocks are doing well. The one thing that we're still worried about, which we hope will change soon, is the financial stocks are not rallying.
Yeah, I wonder what you think about financing costs for companies, though, right? Because they price their bond offerings off of treasuries. And if treasuries interest rates all of a sudden shoot up because they drop a notch in the credit rating, isn't that a problem for corporate America?
Not really, because the rates are so low right now. So, companies like IBM and some of the other ones are refinancing at 1 and 2 and 3%, which isn't a problem. I think the bigger problem is the Japanese and the Chinese own most of our treasury bills, and that's about 30% of the ownership. And if they decide that they want a higher rate, that may be a slight problem going forward. And we have to finance this, 30 trillion asterisk number, a 30 trillion asterisk number out there, and that can be a problem.
You still think we'll get that AAA downgrade by June, July? I think that's what you
the
said
fact
to
that we're
us.
now talking about, where no one was talking about a year ago, yes, I think it's coming, if I'm wrong by a month, but the numbers are there. So, whether it happens
doesn't really matter.
It doesn't really matter. The numbers speak for themselves.
But it'll spook the markets.
Well, of course it will. But, right now we're in a giddy period. Earnings are great. And as we've said on here before, the economy's good. There's nothing wrong. Now, it may change, but the point is you still have this big macro problem we have to take care of.
Got to run. Steve, thank you as always. Steve Kroll joining us here of Moness Crespi Hardt Co.